Breaking news, stocks surge out of oversold conditions. Don't believe me? Watch this study and you will see why. So why are stocks going down? It's basically because rising interest rates. Okay, here we're looking at the 10-year yield. It's already up to 4.96%. This is the highest level since 2007. So what does that mean? Well, when rates go up, that means the cost of capital goes up. It really chokes out some of the smaller companies out there, and that's why you're seeing a lot of underperformance right now. And listen, where are people going with their money? Well, they're taking it out of stocks and they're putting them into rich Treasury bonds like this ETF here, SGOV, ticker is SGOV. Notice here, if we go back 1 year ago, basically at the market low of October 18, 2022, the AUM for SGOV, right? And this is holding 0 to 3 month Treasury bonds. It had $5 billion in AUM. Well, look at this. It's already up to $17 billion a year later. So that is where the money is flowing right now. It is into safety. So if money's going into these short-term Treasuries, where is it coming out of? It is coming out of the stock market, and a beautiful way to see that is with the big money index. So this yellow line, that is our line of truth. If it's going up, that means money's flowing into stocks. If it's going down, well, that means money is coming out of stocks, and we've had a huge flush of capital out of stocks since late July. However, we are in the green zone, right? The BMI, it's oversold. You guys have heard me talk about this so many times. This is a very positive development. This happened last October. In 2022, stocks started a monster rally afterwards. Let's go ahead and rewind the tape. So a year ago, okay, October 2022, people were talking about a near guaranteed recession. You know what Map Signals was saying? Listen, we are seeing some of the most oversold conditions, the weakest breath ever. And we put a study out there saying that this is from literally October 17th. We put out this study. S&P 500 returns post a 5-week buy average below 8.5%. So that's basically saying that anytime when you go over 5 weeks and over 90% of stocks get sold, here's the forward returns. This is going back to 2012. Check this out. A month later, the S&P is up 8%. It's up 16%. 3 months later, 12 months later, it's up 40%. So we put this out in 2022. Look at what happened. S&P 1 month later up 7%. 3 months later, it's up 8.5%. A year later, right? This is right when we get oversold again. The S&P gained roughly 19%. If you look at this, going back to 2012, it had a 100% hit ratio for 1 year out, and it is a 100% hit ratio for 2 years out. Listen, don't bet against data. So now that we are oversold, I'm going to prove to you that stocks tend to surge out of oversold conditions. So this study is going back to 1990, including some back-tested data. It's basically looking at the last day of oversold, what happens to the stock market going forward. First thing I want to show you is that we tend to stay oversold for 18 calendar days. All right, so when we started going oversold on the 9th, you got to wait 18 calendar days to hit the average time we get oversold. But check this out, a week later, once we get out of oversold and that yellow line starts to perk up again, the S&P is up 2.1% a week later. A month later, up 3%. 6 months later, up 9.1%. And up 15.5% 12 months later. And that's an 83% positive instances. Guys, if you play Texas Hold'em, 83% is about the odds you're going to get in a heads up match, and you're holding aces. So the stock market is giving us aces right now. Stocks tend to surge once we come out of oversold conditions. You remember to hang in there. Be looking for great stocks on sale. I'm telling you, these oversold conditions, they won't be around forever. Go to mapsignals.com, sign up for our free insights. I'll talk to you next time.